Hello, and thank you everyone for joining us for this Lawyers for Learners webinar, Making the Most of Your Tax Returns. My name is Liam Coughlin. I'm an MATC student and Lawyers for Learners intern working in the Student Legal Aid Project. The Student Legal Aid Project works to reduce barriers to employment for both students and community members through no-cost legal services. It is my distinct honor today to introduce our presenter from Legal Action of Wisconsin, Chris Anderle. He's a tax attorney and the director of the Low Income Taxpayer Clinic at Legal Action of Wisconsin. Thank you all for being here with us today, and thank you, Chris, for sharing a bit of your expertise with us. With that, I'll pass it along to Chris.
All right, welcome everyone. So you can see title, Credits, Deductions, and Refunds, How to Make the Most of Your Returns. There's two goals for today. I want to teach you to maximize your refunds and minimize your tax burden. And I want to promote literacy. You should be able to understand why your taxes are what they are and why your refund is what it is, or to be able to identify an error when it's made. Slideshows. Okay, slideshows. There we go. All right, so first of all, filing deadline, April 18th, 2023. You can file a request for an extension on the IRS website. Now, to be clear, when you're filing an extension, what you're really doing is you're saying to the IRS, don't make me pay a penalty for filing late or for not paying you. And those penalties only apply if you actually have taxes to pay. So if you get a refund, there's not going to be a penalty with the IRS. But these dates are important to keep in mind. So April 18th, October 16th, if you extend it. Just as important, if you have past due returns, prior years, or if you can get a refund by amending your past return for 2020, for 2021, 20, or 2019, the dates below show you the last days for you to file your initial return or your amended return to claim your refund. And that includes economic impact, income credit if you didn't claim it, or a return of your withholding if you qualify, child tax credit, all the good stuff we're going to talk about today. And these credits were much more generous in 2021, specifically the child tax credit and earned income credit were extremely generous in 2021. So if you didn't file in 2021, and if you have children or if you had earned income, I encourage you to file a return. All right, so I see this all the time. People don't get their full refund amounts by either filing incorrectly or by not filing. So you got 3 years after the due date to go get that money. As I mentioned, no federal file penalty if you did not owe tax. IRS will pay you interest for claiming your refund late. The only thing that really sucks about filing an amended return or a late return is you have to file a 1040X. The 1040X is for an amended return, but if you file late, you have to do a paper filing. In general, the IRS has relaxed this a bit, but paper returns take a long time for the IRS to process. They're getting better, but so it could take some time to get your money back. Do you have to file? See these numbers here, you can tell. So it's a useful PowerPoint, or it's a useful presentation, at least, just for this table. You can find this information online, obviously, but, if you're a single individual, you don't have to file a return if you make $1,950. The thing is that if you make any amount of money, you're probably going to qualify for the earned income credit, so even though you don't have to file under these amounts, generally speaking, if you earn money, you probably should file. So these are the big ones. Almost very few people are, you'll see when you go through the instructions, you'll see there are just tons and tons and tons of credits, deductions, etc. Almost none of them apply to ordinary people. You have to be doing special activities, to be itemizing, and we'll talk about that. In general, these are the ones that are going to actually make a difference to your return or your refund. Earned income credit. Single person, $50 maximum. But if you have 3 or more children, you can get up to $6,900 this way. Child tax credit, $1,500 refundable per child. This is just the refundable amount. We'll talk about it. Child and dependent care credit. That's, well, you know, I guess we're going to get to all this. So you can get a return of the taxes that were withheld when you filed your W-2, depending on your income. And then with the state, the big one, of course, is the homestead credit. You can get up to $1,168. But you put all that together, if you're talking about 1728. If you have 3 or more children, you could be looking at upwards of $14,000. So here are the penalties, right? So you'll see both the federal penalties for failure to file and failure to pay are based on the unpaid tax. So if you don't owe any taxes, you're not going to have a penalty. The only real catch here is if you underreport intentionally. If there's, you know, you try to pull, you know, you try to claim a dependent that clearly wasn't your dependent, you could get hit with an underreporting penalty, which is 20%. If it's fraud, it can be 75%. You know, if you don't state income that you had, you know, like that was reported to the IRS and it was a large amount, you could get hit with that 75% penalty. So, you know, make sure you don't try to pull anything with the IRS. The way it works, the way the IRS generally works is they get information returns. Every time you get a jackpot at a casino, the casino sends a form to the IRS telling them what bank interest you paid. The IRS gets a form for that. Your employment, your employer will send the IRS a copy of your W-2. They'll send a copy of your 1099 if you're a contract employee or not a non-employee, but a contractor. So altogether, the IRS gets a really good idea of what you made. And if you don't include something that they know that was reported to them, then you could be subject to that underreporting penalty. Filing is free. It's free for everybody. But people with complicated tax returns, they have to use software. The more complicated your returns, the more it's necessary to use your software. I'm a tax lawyer and I find this stuff complicated when I have to actually go through the instructions. They can be Byzantine, mind-boggling, right? The instructions aren't always clear. And, you know, and once again, I'm a tax lawyer, so I understand what they're saying. It's not always. But the important things to know are you can get your forms online if you're comfortable with it on irs.gov and prepare them yourself in e-file. But if you earn $73,000 or less, you can use the free software. And if you earn less than $60,000, you can go to a Vita Clinic, which is where you get personal assistance to prepare your returns. That's $60,000 or less. It's a general number, but you can go to a Vita Clinic. If you make over $73,000, once again, I do recommend that you use low-cost software preparation services. Don't use those pop-up stores on the side of the tax season. You know, those preparation services generally overcharge. Every one of my clients who has used those, they'll pay some absurd amount to have their taxes prepared. I highly recommend that you use low-cost software if you make over $73,000, and otherwise use the free software on irs.gov. So, Tax 101. This is how you calculate your taxes. Your income minus your you used to say deductions, but it's business losses, because really the changes in the Tax Cuts and Jobs Act of 2017 made it such that almost everybody takes the standard deduction, almost nobody itemizes. And the only losses that remain to be calculated to calculate your adjusted gross income are your business losses. So income minus business losses equals your adjusted gross income. Adjusted gross income minus your standard deduction equals your taxable income. We'll get to the standard deduction table in a second. And then the tax rates are applied separately to each portion of your taxable income that is within the bracket. So that is to say, it's never the case that when you earn an additional dollar that you get into a new tax bracket and that all of your income is now subject to that tax. No, that's not how the brackets work. The tax rates are applied. Oh, I might as well wait for the table. Finally, tax minus credits equals your amount due. And if your amount due is under 0, that's a refund, right? So what is income? Everything is income. Pretty much everything is income. You can read this list here. I'll read it. Compensation for services, prizes, gambling winnings, interest, unemployment compensation, gains from your sales, retirement distribution. A treasure gold. It's income. So if it gets a little complicated on the edges. If you find if you come into somehow you find like a Stradivarius or something, that'll be a complicated tax case. I'd have to research it. All those are very interesting, but in general, all of the money that you get is income. The important exclusions are gifts. Gifts are not taxable to you, at least. They can be taxable to the person who gives the gift. I'm not going to get into that. Social Security, if your income is below $25,000, it is your Social Security income is excluded. Tax between 50% and 85% of your Social Security becomes taxable above that amount. Scholarships, if they're used for education expenses, those are also excluded. If you use the money for tuition, books, supplies, if you get money that is sort of just free, that you can do whatever you want with, and you can, spend it on room and board or whatever, that would be taxable. But you would get a 1099 from the school that shows the amount of your taxable scholarship. And this is sort of the rule for everything. You should always, from any institution, you'll always be getting 1099s. The only people who aren't going to be giving you 1099s are like if you have a small business and you have customers, they can't send you 1099s. You have to report that yourself. A lot of complications arise from that, and we'll talk about it. But here's the standard deduction. So since 2018, almost all taxpayers take the standard deduction. You can see for single people and married filing separately, it's $12,950. Head of household, much higher, $19,400. Married filing jointly, $25,900. And we'll go into the details of what these are and what I would recommend. So, head of household, unmarried taxpayer who has a dependent who lives with them in their household for the entire year. Dependent is a child under 19, 24 if they're a student, or a qualifying relative earning minimal income. Qualifying relative, it just means like, they're your relative. Basically, there's a lot of rules, but it's basically they're your relative. And then the head of household must pay to maintain the household. They got to pay rent, mortgage, food, utilities. This gets audited sometimes, and if you got audited for claiming that you're head of household when you're not, you'd have to show that your dependent lived with you, and you'd have to show that you paid rent, that you paid for food or utilities. Usually the IRS will let you get by with just showing that a rent certificate and utilities payment for the year. But you really big standard deduction. So if you can qualify for head of household, it's important that you know that you do qualify. Make sure you check that box. Filing jointly versus separately. In general, it is better to file jointly. Joint taxpayers have double the standard deduction. The tax bracket thresholds are double. That's a big one. Basically means that on your combined income, you will pay less than you would separately. There's special cases where, if you make a lot of income or one person earns dramatically more than the other, then it might make sense to file separately. If one of you has an enormous amount of healthcare expenses, over 7.5% of your AGI, then it might make sense to file separately. But the big one is that married people must file jointly to claim the earned income credit. So, I've seen this a lot. People will file separately thinking it does them some good, but then they can't claim their earned income credit. It's important to, for most people, this is a simple analysis. If you're an ordinary person, I'm such a person. You file jointly. The big reason why you would file separately, other than the ones I mentioned, is that say you marry somebody and they already had tax liabilities and you don't want to be liable for their past tax liabilities. Well, then you could file separately, and that way you don't become obligated to pay their, to have your refund applied to their old tax debt. Or, and you don't for future tax burden they have, right? You want to be protected from their future liabilities by filing separately. So here are the brackets. I'm not going to go over them too much, but it's important to realize how this works, right? So if you say you make, and I'm going to go with $80,000, and you're a single person, so your standard deduction is $12,950. I'm going to round it, so you make $67,000 taxable income. The first $41,000 is going to be taxed at 12%. The remainder is going to be taxed at 22%. You see, it's not that you make more money and now all of a sudden all of your income is taxed at 22%. Important thing, a lot of people don't understand this, but it's important to understand how the brackets work. In other words, the first $42,000 of your $41,775 of your taxable income will always be taxed at, well, up to $10,275, it's 10%, and then it's the rest of it is up to 12 is taxed at 12%, and then etc. Same table, married filings. So you can keep this, and this is just for 2022. They adjust them every year. Now, earned income credit. Who qualifies? Everyone who resides in the United States for more than half the year, age 25 to 65, who's not a dependent. And once again, you got to file jointly if you're married. If you got kids and you're going to claim the earned income credit on their basis, then they need a Social Security number or a taxpayer identification number. You can give a taxpayer identification number. I don't know how many people here are, non-U.S. residents. So I guess I don't really have time to go into all that, but there is, if you make more than $10,000, $10,300 of investment income, then you don't qualify. Here are the maximum amounts of maximum amounts of adjusted gross income you can make to qualify for the earned income credit. A single person, it's only $16,480. If you make above that, then you're not going to get the earned income credit, but you can see how much higher it is if you have 2, 3 children, 1, 2, or 3. It's much higher. So a lot of people qualify for the earned income credit. It's based on earned income. That's W-2. It's generally W-2 tips and 1099 income. Excludes Social Security, unemployment, other stuff. If you, I've seen quite a few people try to claim the earned income credit by including their unemployment compensation as earned income, and that's just not the way it works. It has to be money you actually work for. Not saying you don't work for unemployment, but not regardless. Big thing that trips a lot of people up is if they've got a small, I give the example of hairdressers, artists, babysitters. There's lots of stuff that people do sort of like as a side gig. Musicians, you're not going to be getting 1099s for this. Nobody's reporting the income that you make to the IRS except for you. You're going to have to report it on your Schedule C, and you're going to have to keep records of all this, receipts of your sales, of the inventory that you purchased. You got to keep records in order to be able to claim this. And the reason you want to claim this is, say you make $15,000 as a hairdresser. Well, you want to claim the earned income credit, especially if you have kids. That's quite a lot of money you could be losing if you don't keep good records of your business income. So, this is kind of important for a lot of people, and it's a big thing that they miss. So a lot of, I don't know how many people miss this one, but say you sell stuff for a living. Say you sell stuff on eBay, right? You pay 10 bucks for something and you sell it for 20. Well, you got to keep records of the amount that you spent on your items. If you do that, then you're only supposed to be taxed on the gain from the sale. You sold it for 20, you bought it for 10, you have $10 of gain. Your tax should be on $10 of gain. If you don't keep records of your expenses, you very well could be required to pay taxes on everything you sold without accounting for how much you spent on this stuff. And it can be a dramatic difference. I mean, so you know, it's just important. The important thing is, if you're conducting private business, whether it's through selling or through your services, you got to keep your receipts. You got to keep good records. That's the only way that you're going to be able to make sure that you don't get bit at the end by the IRS. Here's how you calculate the earned income credit. This was far more generous in 2021, especially for an individual. This was doubled, I think, to 15%, or was it 14%? I don't recall, but up to these amounts, you get this much. I'm not going to read this. You guys can read it. Right? But you can see it can be quite substantial. Qualifying child, sibling, step sibling, or descendant under 19, 24 of student, or totally disabled. So, if you got an adult child, but they're totally disabled, they can be a qualifying child, qualifying you for the earned income credit. They have to live with you for more than half the year in order for you to file a joint return. Child tax credit, $2,000 per child, but only $1,500 of that is refundable. So essentially you calculate it twice. Calculate it once when you're calculating how much your tax burden is. And then when you determine your refund, if you qualify for a refund, you calculate it again using only $1,500. It's available for everybody earning under $200,000, individuals, $400,000, married filing jointly. There's a phase out. The thing is that most of this stuff is going to be calculated for you by the software if you use software. It's just important for you to understand what's available. And, if you're going to do it yourself, you got to understand how it works. You got to understand. I think it's important for people to understand how it works so that they know, tax credits are the main way that the primary way the government gives individuals private monetary subsidies. It's the way that the government gives people money who need it. Everything else, is almost all of it's done through businesses. It's all indirect services provided. This is how you get money from the government, and they want to give it to you. They wrote these laws for a reason. They want children to not be in poverty. They wanted that a whole lot more in 2021 than they do this year. The child tax credit in 2021, I don't remember off the top of my head, but I think it was it's $3,000 and $3,600 depending on the age of the child, per child, refundable. That's substantial. It's still substantial, so you got to make sure you get it if you qualify. It's only available for kids who are 16 or younger at the end of the year. They have to live in the U.S. and they have to live with the taxpayer more than half the year. And they got to be your child or your sibling. They can qualify, or a descendant of your child or your sibling, so your grandkids, your nephew will qualify. Child independent care credit is a refundable credit for people who work or go to school, who send their kids to daycare. You got to get a receipt from, essentially statements from your care provider. You provide that information to the government on the appropriate form 2441, and you can up to $3,000 per child, up to 2 children, so $6,000 max. The government will actually pay you that money, so they will pay to pay your child care provider. Same thing as you have a dependent who needs care while you go to work. I'm not going to go into the rules for dependents. Some of those rules can get a little complicated, but the general, you get it. Child must be under 13 in order to qualify for this, or independent, incapable of self-care. And then there's the state. So Wisconsin provides the homestead credit. You can file Schedule HEZ with Form 1. You don't necessarily need to file your state return in order to claim the homestead credit. You can file Schedule HEZ, and you can, I think you write at the top, like no return filed, and you can file just the Schedule HEZ. If the credit amount is, if your household income is less than or equal to $8,060, it's 80% of the property tax allocable to the residents. So, you know, that can be a little harder to figure out if you're renting. Oftentimes your landlord will tell you, but you can, often look it up online. If you've got a big residential building and there's, 40 units, you can see how much property tax was paid in 2022 and divide it by the number of units. If your household income is over 8,060, it's, well, the calculation is pretty terrible. The amount, 80% times the amount of property tax that is in excess of the amount by which your household income is in excess of 8,060 times 8.785%. I'm not going to explain that any further. But that's the thing. Most of the time you can figure this out by just filling out the forms. They'll show you. It's available for non-dependent. So if you're not claimed as a dependent on somebody's return, Wisconsin residents who are 18 and over, who own and occupy or rent a dwelling on which property taxes are paid. Your household income has to be less than $24,680. And either you or your spouse earned income or is disabled or is 62 and over. This one you can claim up to 4 years after the April 15th due date. It's always April 15th in Wisconsin, at least for this purpose. So if you would have qualified for the homestead credit in 2020, you can still file the Schedule HEZ with the Department of Revenue and get your money. If you're a renter, you do have to get a rent certificate from your landlord. Quick note, because a lot of students here, student loan interest deduction, you can still take this deduction. Most you can no longer take, but this one you can. For up to $2,500 of student loan interest that you pay in a year, that's this year's rule. I think it's consistent in future years too. You will get a form. I forget the form you get from the bank that you pay the interest to. This is not just somebody asked this question when we were preparing for this. This is not just for federal student loans. This is for any student loan. It's not refundable. So all it does is decrease the amount of your taxable income. So it just reduces your taxes. It doesn't result in a refund. It phases out for people who earn income above $70,000 or $145,000 or are married filing jointly. Now, here's a little warning. So as I said, they got rid of most of the itemized deductions. They got rid of some personal deductions outright. This has resulted in a lot of inequity in the tax world, my world. So I've listed some of the problems I've seen here. Gambling losses. If you get a jackpot at a slot machine, I think it's over $1,200 current law, that gets reported to the government or to the IRS, and you will get, the IRS will tell you if you don't claim this on your return that this was income. Now you'll probably say, wait a second, these are slot machines. I lost money at slot machines. Who makes money in slot machines? Well, the IRS thinks everybody does, because you can only deduct the amount that you lost at the machine if you itemize. So that means that if you're an individual, then you have to make more than, assuming no other itemized deductions, you have to make $13,000. You have to have $13,000 in losses before you can claim any of them. And then, if you had $13,000 in losses, the benefit is only $500 more than if you just took the standard deduction, which means that your gambling winnings are essentially, it's like a gross tax. It's taxed as if you made that money. Any losses? I mean, I know it might sound like not a big deal to some people, but there are people who spend a lot of time in casinos and they don't realize that they're going to get hit with a terrible tax bill at the end of all this. Charitable donations used to be able, these were itemized deductions. Now, you could take $300 in charitable donation deduction in 2020. When people say, would you like to give us a tax deductible, donation? Generally, they're not. You have to itemize in order to claim it. And as I said, almost nobody itemizes. You'd have to have $13,000 in itemizable deductions for you to be able to take the deduction for a charitable donation. Medical expenses, once again, these are itemized. You can only take them, all of these. Tax preparation fees, mortgage interest. Mortgage interest deduction used to be huge. Now, about 90% of people can't claim the mortgage interest deduction because, once again, if you're married filing jointly, you need around $26,000 in order to, or I'm sorry, about $26,000 in itemized deductions before it has any benefit to you. So the mortgage interest deduction for 90% of people is gone. And this is the big one. I have a lot of clients who were the victims of scams, theft, and they straight up took this deduction right out of the code in the 2018 Tax Cuts and Jobs Act, which means that, if your grandmother gets scammed out of $100,000 and she took that money out of her IRA, she'll be hit with a bill for that full $100,000, even though she didn't get any of it because it was stolen. Congress decided to get rid of that. I guess the lesson here is don't be the victim of a theft, or don't have your house burned down. But these are some of the things you got to be aware of, just because these are sort of like the pitfalls that people fall into.
Well, thank you everybody for joining us today.